Meet Sarah. She is a dedicated graphic designer living in Melbourne, earning a solid income of $95,000 a year. For the past 5 years, she has diligently saved, accumulating a respectable deposit of $100,000. Her dream is simple: to own her own home, a place to call her own in a city she loves. However, as we navigate the property landscape of 2025, Sarah's journey is becoming increasingly challenging. The goalposts for homeownership seem to be constantly shifting, pushed further away by a combination of rising property values and a tougher lending environment. She feels like she is running a race where the finish line keeps moving. The reality for many aspiring homeowners like Sarah is a frustrating cycle of saving and falling behind. She watches property prices in her desired suburbs climb faster than her savings account can grow. Every weekend is spent scrolling through property listings, only to find that what was once within her reach is now a distant dream. The interest rate hikes over the last couple of years have significantly impacted her borrowing capacity, making the amount banks are willing to lend her much smaller than it would have been just a few years ago. This reduction in borrowing power is a common story across Australia, leaving many potential buyers feeling disheartened and questioning if they will ever get a foot on the property ladder. Sarah's situation highlights a critical question for all prospective buyers. What can you really afford? It's not just about your deposit. It's a complex calculation involving your income, your genuine living expenses, any existing debts, and the stringent serviceability tests that lenders apply. Banks are now more cautious than ever. They meticulously scrutinize every aspect of a borrower's financial life to ensure they can comfortably meet mortgage repayments, not just at current interest rates, but also with a significant buffer built in for potential future rate rises. For Sarah, this means her dreams of a 2-bedroom apartment in Fitzroy might need to be recalibrated. This new reality forces buyers to be more strategic and informed than ever before. The dream of homeownership is not lost, but the path to achieving it has changed. It requires a deeper understanding of the financial levers at play and a willingness to adapt one's expectations. For Sarah and thousands like her, the first step is to move beyond online calculators and gain a crystal clear picture of their true borrowing capacity in today's market. It's about facing the numbers head-on, understanding the limitations, and then building a realistic plan to move forward, whether that means adjusting location, property type, or saving strategy. So, what exactly do banks look at when deciding how much they will lend you? It's a detailed process designed to minimize their risk. The primary factor is, of course, your income. This includes your base salary, but lenders may also consider overtime, commissions, or bonuses, though often at a discounted rate. They want to see a stable and consistent earnings history. A higher income generally translates to a higher borrowing capacity. However, income is only one part of the puzzle. The bank's main concern is your ability to service the loan over its entire term, which is typically 30 years. Your living expenses are scrutinized with a fine-tooth comb. Lenders don't just take your word for it. They use benchmarks like the household expenditure measure and will also analyze your bank statements to understand your actual spending habits. This includes everything from groceries and utility bills to entertainment, subscriptions, and travel. Having significant discretionary spending can reduce your borrowing power. Furthermore, any existing financial commitments are a major factor. This includes personal loans, car loans, credit card limits, not just the balance, and HECS help debt. Each of these liabilities reduces the amount of income available to service a new home loan. Let's look at some practical examples for 2025. A single person earning $80,000 with minimal expenses and no other debts might be able to borrow around $400,000. A couple with a combined income of $150,000 could potentially borrow closer to $750,000, assuming they have their expenses under control. However, add a $30,000 car loan and a couple of maxed-out credit cards, and that borrowing capacity could easily shrink by over $100,000. This is where the impact of rising interest rates becomes stark. A few years ago, that same couple might have been approved for close to $900,000, illustrating just how much borrowing power has been eroded. The bank's serviceability buffer is the final, crucial hurdle. Lenders are required by the Australian Prudential Regulation Authority to assess your ability to repay your loan at an interest rate that is at least 3% higher than the actual loan rate. This stress test ensures you can handle future rate increases. So if you're applying for a loan at 6%, the bank will calculate your repayments as if the rate were 9%. This buffer is the single biggest reason many Australians have seen their maximum loan amount decrease so significantly, forcing a widespread reassessment of property goals across the nation. The Australian property market is not one single entity. It is a collection of diverse markets, each with its own price points and challenges. What you can afford in one capital city is vastly different from another. In Sydney, with a median house price well over $1.3 million, a budget of $700,000 will likely confine you to apartments or require you to look at suburbs on the city's fringe. In contrast, that same $700,000 budget could secure you a comfortable family home in more affordable cities like Perth or Adelaide, where median house prices are significantly lower. Brisbane and Melbourne sit in the middle, offering a mix of options but with increasing competition in the sub-$1 million price bracket. In today's tough market, savvy buyers need to think strategically. One effective strategy is rent vesting, where you buy an investment property in a location you can afford, such as a regional centre or a more affordable capital city, while continuing to rent in your desired lifestyle location. This allows you to get onto the property ladder and start building equity without compromising your lifestyle. Another strategy is to consider a wider range of property types. Instead of holding out for a detached house, look at townhouses, villas, or well-located apartments, which often provide a more accessible entry point into a desirable suburb. For those with a budget of around $600,000, there are still excellent opportunities if you know where to look. In Melbourne, you might explore suburbs like Melton or Werribee in the west. In Brisbane, Logan and Ipswich in the southwest offer value. Sydney buyers on this budget will need to look further afield to areas like Campbelltown or parts of the Central Coast. For a higher budget of around $900,000, your options expand significantly. You could consider a family home in many of Brisbane's middle ring suburbs, a townhouse in Melbourne's north, or a larger apartment closer to Sydney's CBD. For high-income earners with borrowing capacities exceeding $1.5 million, the market in 2025 opens up considerably. This budget allows for the purchase of quality family homes in desirable blue-chip suburbs across all capital cities. In Sydney, this could mean a house in the Upper North Shore or a semi-detached home in the Inner West. In Melbourne, it unlocks opportunities in sought-after school zones like Balwyn or Glen Waverley. Even with a higher budget, the principles of smart buying remain. Focus on A-grade properties in locations with strong long-term growth drivers, such as proximity to transport, amenities, and good schools. If the bank's initial assessment leaves you short of your property goals, don't despair. There are several practical and legal ways to stretch your borrowing power. One of the most effective methods is to aggressively reduce or eliminate existing debt. Pay down your personal loans and credit cards as much as possible before applying for a loan. Even lowering the limit on your credit cards rather than just the balance can make a significant difference, as lenders assess you on the full limit. Closing any credit card accounts you don't use is a simple but powerful move that can instantly boost your perceived serviceability. Another key strategy is to demonstrate a strong and consistent savings history. Lenders love to see genuine savings accumulated over time, as it proves your financial discipline. Try to minimize your discretionary spending for at least 3 to 6 months before you apply for your loan. This means cutting back on dining out, subscriptions, and online shopping. A clean bank statement, free from frequent cash withdrawals or transactions with buy now pay later services like Afterpay, presents you as a lower-risk borrower. This financial detox can have a surprisingly large impact on the final loan amount you are offered. Increasing your deposit can also help, as it reduces the loan-to-value ratio. A lower LVR means you are borrowing a smaller percentage of the property's value, which can help you avoid costly lenders' mortgage insurance and may even unlock a more competitive interest rate. Consider exploring government assistance programs like the First Home Guarantee, which can allow you to purchase a home with a smaller deposit without paying LMI. For some, seeking a guarantor loan, where a family member, usually a parent, uses the equity in their own property as additional security, can be a viable path to securing a larger loan. Ultimately, navigating the home loan process in 2025 requires preparation and expert guidance. The best next step for any aspiring buyer is to engage a proficient, independent mortgage broker. A good broker can assess your specific financial situation, compare loan products from dozens of lenders, and help you structure your finances to maximize your borrowing capacity. They can identify which lenders might look more favorably on your circumstances and guide you through the application process. With a clear understanding of your borrowing power and a strategic plan, you can confidently take the next steps towards securing your new home.